Okay, so right now we are going to start with derivatives. As you can see, we are going to deal with the literal meaning of what derivatives is. Now, as we can see, derivatives is basically it's something which derives its value. Value from whom, value from where? The value is derived from an asset. So what exactly can be derivatives termed as? Is it a security? Is it a financial security? Yes, it is a financial security. So basically, derivatives is something which can be related with stocks and bonds, but it is different from stocks and bonds or commodities. Why? Because derivative is something which derives its value. What does it do? It derives its value. If it derives its value, it is known as derivatives because it derives. It derives from whom? It derives from an asset. If it derives the value from an asset, what could be that asset? That asset could be a commodity, that asset could be a currency, that asset could be a stock, could be bonds, could be interest rate. So it derives a value from an asset which could be commodity, interest rate, or stock, or bond, or currency. And this is a type of financial security where the value is derived from a particular asset, and on that value people do trade. So who could be the traders in derivatives? There could be speculator, there could be a speculator, there could be an arbitrager, and there could be a hedger. So these are the three different types of people who trade in the derivatives. So what do you mean by a speculator? A speculator is a person who lives on betting and tries to earn the money by betting. Betting on what? Betting on a derivative. So they try to bet on a particular price, whether it's going to go up or down, and that is known as a speculation contract. Who could be an arbitrager? We are going to deal with this in a while in equity and derivatives, but once again, arbitragers are those people who try to make profits from mispricing in the securities in the market. What do you mean by mispricing? All these things you can leave it for equity, where we would be dealing with the intrinsic value and the real value, and in equity we would be understanding the calculations and the valuations of a stock. And the valuation of the stock which we have calculated using different equity models is different from the value which is trading currently, and when there is a difference, there is a chance of arbitrage. What about hedgers? The hedgers are those people who are afraid of the price rising or falling. Maybe a commodity seller, like wheat seller. Who is a wheat seller? A wheat farmer is a person who sells wheat. If he is expecting that the price is going to fall, he's afraid of the price fall. And when he's afraid of the price fall, he would love to hedge his wheat by selling the wheat futures. Now, when you should sell, when you should hedge, when you should buy, and when you should go long. So these would be the series of discussions in the derivative curriculum. So now this is where it is a financial instrument where the value is derived, from where it is derived from an underlying asset, where the asset could be your stock, equity stock, or maybe bonds, or maybe your currency or commodity. Moving on from there, we are trying to see what are the different types of derivatives we are exposed to. We are exposed to forwards. Now in forwards and futures, the only difference is futures are traded in the exchange traded funds or exchange traded market, which you call it as ETF. And when you're talking about the forwards, it is traded at OTC, which is known as over the counter market. So there are two types of market which we are going to deal in a real quick short time, which is the OTC versus the exchange traded funds. Now in the exchange traded funds, you deal with the futures, and in the OTC market we are dealing with the forwards. And then what are the other types of derivatives we are exposed to? We are exposed to swaps. What are the swaps? The swaps could be when you're trying to hedge yourself against any risk of the interest rate movement. This is known as an interest rate swap, also known as a plain vanilla swap, or known as the basic plain swap. Then what else are the different varieties of swaps? We have equity swaps, where you're afraid of the equity returns. You try to exchange in exchange of the equity returns, you are exchanging your returns of the equity with the LIBOR rate, LIBOR, LIBOR. It is London Interbank Offered Rate. Now these are the different reference rates we can be using in finance, one being your LIBOR, one being your MIBOR, one being your EURIBOR. So what else could be the swap variety? You can get an exposure to the currency swaps as well, where you are afraid of loaning one currency or you are afraid of lending one currency to another party or for any other project. And then we have options. We will be dealing in detail about options, where we have two types of options. One is your call option and one is your put option. So there are two varieties of options which is going to be discussed in this session. And then you have the credit derivatives, which is of one type, which is known as the credit default swap. All these things would be the series of discussions, and in the end there are exotics. Now these are the exotic varieties of options, and these options are really different from the regular options which we are going to see, and we would be having a discussion on the exotic options as well. Now looking at the advantage of the derivatives, now why would you generally prefer a derivative market over the stock market? Now when we are talking about the stock market, when we are talking about the commodity market, or when we are talking about the bond market or currency market, these are the types of markets which you call it as a cash market. Now why do you call it as a cash market? Now this is because you are trying to deal with the physical commodity. You are trying to deal with the physical commodity. Now when you're talking about the physical dealing, you are either trying to buy the asset or you are trying to sell the asset. When you're trying to buy the asset, definitely you are giving cash, and when you're trying to sell the asset, you are receiving cash. But what happens in derivatives? Do you have any physical trading? No, it all happens on the value. You're trading not on the stock, you're not trading on the physical quantity, but rather you are trading on the value of a particular stock. And then there are some advantages to follow. Some advantages, like you can go short. What do you mean by going short? Now this going short is coming from the word known as short selling. Now when you're talking about short selling, what does this mean? It means you don't have a particular stock, but rather you are borrowing the stock from someone else and you are trying to sell it. This is the meaning of short selling. But over here in derivatives, how we can link this meaning of short selling with this phrase known as easier to go short? It means you don't have to physically own a particular commodity, and still then you can take a selling position. If you remember, a couple of minutes back I had given an example about the wheat farmer. Now the wheat farmer is a person who is selling stock. Now assume that I'm speculating that the prices of the stock is going to fall, and it is going to fall as a result of which I want to protect my wheat futures. So when I want to protect my wheat futures, I would go for a sell position or a short position. That means what I would do is I will go for wheat futures minus position. Though I don't have the commodity right now, but still I can take a wheat futures sell position or a short position. Now if I do that, then I can say that even though I am not physically holding this commodity, I still have a sellable position or a short position. If the price of the futures fall, then I gain out of this transaction, and if the price of the futures rise, then I lose. Now moving on towards the other advantage, it helps in taking a higher degree of leverage. Now what does this mean is you are getting a chance to borrow from the broker and invest. This can be applicable, or this can be used only in the derivative market. Lower transaction cost. Now as in case of buying a particular commodity, it physically involves a lot of cost, takes a lot of cost, as in the stock handling cost, the carriage cost, the ordering cost, or there could be any other cost which is related to the nature of the commodity. But if you are buying gold futures, instead of buying gold, you are just taking a transaction on the value of the gold, but you're not taking a transaction on the physical commodity of the gold, as a result of which a lot of transaction costs get saved. What next? You have higher liquidity. What do you mean by liquidity is how quickly you can liquidate your resources and pay money to fulfill a future liability obligation. Now when you're talking about a future liability obligation, you're talking about how good your liquidity is. What does this mean? It means how how liquid funds, how much of your funds are liquid in nature. That means how much of your funds are readily available in nature to satisfy a future liability obligation. Now, what is the relevance of this in the derivative market? It means in derivatives, if you're trying to get a derivative position, may that be a long or may that be short, you are getting a chance to sell that futures, or you're getting a chance to buy a future or sell the future in one short span of time without any hassle, which means if you want money from the invested derivative position, you can immediately sell and you can recover the cash and you can pay off a future liability obligation. This is what liquidity means. Higher liquidity. Derivatives allow higher liquidity. And then effective risk management. The best example of this can be taken with the help of a wheat farmer and a bakery firm example. Now, this is a very famous example which is being used everywhere. Imagine that there is a bakery firm, I can term it as BF, bakery firm, and there is a wheat farmer. So the wheat farmer is selling the wheat to the bakery firm, and bakery firm is buying wheat to manufacture bread. Now, what they try to do is these two guys go for an effective risk management using derivatives. Now, the bakery firm is going to receive an order of making 2 tons of bread in the next year. Right now, the bread is being sold at $45. The bread is being sold at $45 a kilogram. The wheat is being sold at $45 a kilogram. Now, the bakery firm wants to buy wheat after 1 year, and the bakery firm is impressed at the price of $45 a kilogram. Now, the bakery firm is afraid of this $45 rising after 1 year. So, if this happens, then bakery firm has to cough out more than $45 after 1 year, which the bakery firm is anyways not interested. But over here, on the other hand, the wheat farmer is afraid of the price falling, since he is the one who is going to sell the wheat to the bakery firm after 1 year. So the wheat farmer is afraid of the price falling below, going down below $45 after 1 year. So what the wheat farmer and bakery firm are going to do is they are going to enter into a contract. The contract where the bakery firm and the wheat farmer are going to deal with this price, that is, they are going to lock with the price of $45 after 1 year, because the bakery firm is expecting the prices to go beyond $45, and the wheat farmer is expecting the prices to go below $45 after 1 year. So why shall we not strike a contract between these two guys, and we shall lock the price at $45 a kilogram. Now, when this happens, the bakery firm would be at a winning position after 1 year if the price actually rises, and the wheat farmer will lose because he has locked the price at $45. Now, what in case we look at the other way around? There could be two situations or two scenarios over here. Either the price will go up to $50, or else the price will go down below to $35. Let's say there are two situations. If the price goes up to $50, then the bakery firm wins $5 because he has locked the price at $45. And if the price falls below and goes down to $35, then the bakery firm loses $10. So, since there is a $10 loss for the bakery firm, there will be an equal and opposite $10 gain for the wheat farmer. And since there is a gain for wheat farmer over here in the second situation where the price falls, there will definitely be a loss of $5 for the wheat farmer in the first scenario. This is scenario 1. This is scenario number 2. So there will be a loss of $5 in the first scenario. And if the price remains constant at $45, then none of the parties to the contract are winners or losers. Now, these are a brief description about some advantages of derivatives, and then getting to the over-the-counter trading platforms and the exchange traded contract platforms, so that is the ETF funds. Now, these are some differences between OTC derivatives or ETF derivatives. We call it as OTC derivatives and ETF derivatives. Now, there are some advantages of OTC derivatives, but not to forget, there are a lot of disadvantages of OTC derivatives. Like, some of the disadvantages is Counterparty can be the another corporate entity. Now there is a new term which I want to introduce over here is counterparty risk. What does counterparty risk mean? If you can see, there are two parties, one is A and one is B. So A and B enter into a contract. Let's take a simple example, whether it's going to rain today. Now if it rains, A speculates that it's going to rain and B speculates that if it's not going to rain. So B says that there would be no rain today and A is speculating that there is going to be rain today. The reality, it rains. When it rains, A is the winner. When A is the winner, A is supposed to receive $10 from B. That's what the contract terms were. If any one of these two parties win, they're going to pay, the winner is going to receive $10 and the loser is going to pay $10. So if A is going to receive $10 from B, then there is a risk that B might run away. Or what in case it didn't rain, then B was the winner and A would have run away. So there is a fear. This fear of running away or the fear of the counterparty not being able to fulfill the obligations as given in the contract is known as counterparty risk. So there is a counterparty risk in over the counter derivative rather than the exchange traded funds. Why? Because over the counter derivatives always happen between two parties. It always happens between two parties and there is no clearing house. There is no central party which you call it as clearing house. There is no clearing house in between. There is no financial intermediary in between. But what happens in the exchange traded fund is there is a party A, there is a party B and there is CCP or central clearing party, also known as the clearing house, which sits in between. Now what happens over here is, now in the same example, let's assume that A is still the winner, and B is the loser. So B is supposed to pay $10 to A, but B is not going to do that. Rather, B is going to pay $10 to the clearing house and the clearing house is going to pay the $10 to A. But of course, there would be some commission which the clearing house is going to retain, but that's not a part of a discussion because we are not going to get into the number crunching right now. So, since there was a contract between A and B, the contract got fulfilled with ease and there was no clearing house, there was no counterparty risk between A and B, and A is well satisfied that even if B is getting bankrupt, A is going to receive money from the clearing house and B is supposed to pay money to the clearing house. So this is the most important point of difference between the OTC derivatives and the ETF fund derivative or exchange traded fund derivatives. There are a couple of more advantages as well. In ETF, you get a feature of mark to market. In OTC, you don't have that. The securities are not mark to market. What does mark to market mean? That would be a detailed discussion which is going to be done later. Liquidity is very high as mentioned over here. The liquidity is very high in derivatives, but always remember that all the derivatives don't have higher liquidity. For example, the ETF derivatives have a higher amount of liquidity, but the OTC derivatives have lower amount of liquidity. Why? Because it is not very easy for everyone to come and trade in the OTC markets. It is not regulated. Again, the most important thing over here is the OTC markets are not regulated. So it looks like it's not over here, but yeah, it's there. It is unregulated. The OTC markets are unregulated, whereas the ETF markets are regulated. So when markets are regulated, you get a smoothened flow of the capital which is flowing in and flowing out of the markets, as a result of which the liquidity gets directly linked with it, and then you get higher liquidity in ETF markets and lower liquidity in the OTC markets. What else? Of course, we have already dealt with this. Higher counterparty risk, no counterparty risk at all because of the presence of CCP, Central Clearing Party, also known as the clearing house. What next? We have some options over here: swaps, exotics, forwards. The most important option over here is the forwards. The forwards are always the OTC derivatives and the futures are always the exchange traded derivatives. Options can be traded in ETF as well as OTC markets. So I hope this will suffice. We'll stop.